Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Maxwell Gold, Director of Investment Strategy for ETF Securities. In today's podcast, we talk about gold and what is ahead for the metal in 2017, especially given the election of Donald Trump. We also discuss some of the other precious metals too, as well as some key things that investors need to keep in mind when they're investing in this space. So make sure to stay tuned for that right after this. Okay, Max, thanks for joining us. Precious metals are always an in-focus topic, so glad to have you on to talk about it.
Yeah, thanks for having me.
First, I want to talk briefly about the recent election and what kind of an impact this has on the precious metals market. Most people thought that gold would surge if Trump was elected, but that hasn't really been the case as metal prices have been kind of flat to or under pressure. So what happened in the market, in your opinion?
Yeah, it's certainly been a surprise. A lot of expectations were with a change in administration, with the result of the election happening, that we would see a bit of a surge driven by that uncertainty. But, sort of the opposite has occurred in the recent week or so in the gold markets. Overall, we still see, the case, and we're still constructive for gold in reflection to the short and medium macroeconomic trends of continued negative interest rate policies, as well as, continued uncertainty both on the macroeconomic landscape as well as the policy uncertainty that a victory by Trump and his administration will, continue to weigh on markets. Overall, short term, it's a bit of a euphoria, but, at the same time, there's a lot of speculation, headlines, and a lot of focus about, what's next, where we go from here. In all honesty, the truth, there's not a whole lot of clarity on what the exact implications of future economic policies by this administration will be. And sort of, I think markets are trying to price that in and try to figure out what are the benefits, the drawbacks of some potential policies that were stated as important on the campaign trail, in particular infrastructure, as well as a focus on a bit of a protectionist view on sort of certain trade policies like NAFTA and TPP. But at the end of the day, I think our view is that this will continue to be a net increase of inflationary pressures, which will continue to weigh on real interest rates, will keep them low for longer, which should be a boon for gold.
Yeah, so we've sort of seen a move in the to a more strong dollar here over the last couple of days following the Trump election, but it sounds like you don't think that's really going to last. Is that fair to say?
So I think we're going to see continued volatility. I do think that we have bottomed out. I think more importantly, there's a bit of a markets are pricing an expectation of an increase by the Fed in December of a rate hike. Our expectation, we will see a hike of about 25 basis points in December. And, we're seeing a similar path as we saw last December where, throughout Q4, markets were expecting the beginning of the interest rate cycle by the Fed for the first time in 10 years. They did hike, Q4 metals, not just gold, but silver and platinum, also sold off through the quarter. But, it was a bit of a sell the rumor, buy the news type of mentality where once markets, were able to price in the actual event, we saw that rebound and a bit of a rally so far this year, which has been a very strong return year to date for most metals. And, we do see the potential for a similar repeat path. We have seen a sell-off, beginning in October in gold, silver, platinum, leading up to a potential Fed hike in their FOMC meeting next month, which we do see potential for continued volatility. But for strategic investors that really view diversification and really look for the benefits as a hedge for gold in particular, we do see the benefit of, as an attractive entry point and potentially another bite at the apple where prices have come down a bit from where we were midsummer.
So you're viewing that the Fed does raise rates here in December. And then what's your kind of take on what the Fed does after that? We have seen, obviously, the Treasury bill yields go up quite a bit in just the week following the election. Do you think that's going to factor it in at all to the Fed's decision going forward? And, what's the impact going to be on precious metals if that's the case?
Yeah, that's a great point. So, we have seen a bit of a tightening in markets already where 10-year yields have spiked up to about 2.2%. They're at about 1.8 before the election. And, obviously the dollar has followed suit with a rising rate in the market for the 10-year. And overall, it's important for a lot of investors. A lot of people think that it's the death toll for metals, in particular gold, which traditionally acts as a monetary asset in a rising rate environment. But what's really the key driver for precious metals are real interest rates. And we do expect inflationary pressures continue to outpace potential monetary policy. We do see inflationary risks to the upside. even with the expectation of increased infrastructure spending, continued fiscal deficit spending, we do think that these are inflationary pressures which will continue to keep real interest rates lower for longer. And not just here in the U.S. but globally, real interest rates continue to be either negative or very low positive, which is a good environment for gold and other precious metals to perform. On average, historically, going back 40 years, precious metals as well as industrial metals perform well when real interest rates are slightly negative to very low positive. We do see a strong performance in gold and silver when real interest rates are less than negative 2%. But even when they get up to about 1.5%, 2% positive on a real basis, we do see average monthly returns for gold and silver still remain positive. It's really when you reach that real 2% interest rate level is when it begins to become a drag for gold and silver. But we don't expect that to really come to fruition for the next couple of years, where based on current Fed trajectory, we do see real interest rates remaining close to zero, where inflation, whether it be on a core or headline basis, is about 1.5%, 2%, which should continue to outpace any potential data-dependent or reactive Federal Reserve Board actions that we've seen and have they've communicated so far.
So it's an idea of, the Fed might raise, but inflation's still going to outpace things just because the Fed is going to remain sort of behind the curve here. Is that fair to say?
Yeah, I think that's pretty much it. And we've sort of seen that, not just in CPI or in goods numbers, but also in labor markets, where that's another factor of inflationary pressures. We have seen an improvement of overall unemployment. We have beginning to see a tightening in labor markets and wage growth so far. And I think that will continue to weigh and actually begin to tighten even further, particularly as we do see a potential boon for any increased infrastructure spending, which has been, a strong promise by this new administration.
So I wanted to switch gears real quick and talk about a different political situation. Over in India, we saw that the country banned its 500 and 1,000 rupee notes, and some people are blaming this for the slump in gold here over the last couple of days, immediately following the election. Obviously, gold is very important for India, and India is a very important market for gold. So do you feel like this is an issue gold investors should be worried about in 2017, or is this kind of just something to keep below the surface for gold investors?
I think it's an important structural trend to see, because obviously India is a very important physical market for gold. It accounts for about 30% of annual demand, primarily in the form of physical bars, coin, and more importantly, jewelry. So it is a key market for gold. But in terms of pricing mechanisms and the day-to-day movements we see in gold market, it has less so to do with the physical markets. They are primarily they help shore up any kind of bottom or a fundamental floor in the overall market. We do see mostly investment flows being the short-term pricing mechanism that drives gold prices day to day. But overall, I think it's an important trend to keep an eye on. But we've actually seen a bit of an improvement so far in Q4, driven by increased seasonal demand from Indian festivals such as Diwali, the Indian wedding season. These are all traditionally parts of the year where we see increased physical demand for gold, as well as going into Q4 with the holiday season. We should see a pickup of jewelry demand, jewelry purchases in Western nations such as the U.S. and Europe. So overall, I think seasonal factors like that are beginning to increase the overall position of Indian demand for gold that we've seen a bit of a weakness at the beginning of the year, which was also reflected of the local premiums, which we've seen a bit of a close. We've seen local discounts in India. Physical gold prices begin to track the global spot price, and that discount has actually closed significantly in the Q3 and Q4. Where in mid-year this year, I think that's just a reflection of very weak physical demand. But as we've seen that discount close, we've seen an increase of physical demand buying due to partly these seasonal factors, as well as a bit of a bargain hunting as the price has recently dropped in the past month or so.
Okay. And let's talk briefly about how investors might invest in gold. So obviously your company has the ETF Securities Physical Swiss Gold Shares, symbol SGOL. Maybe you can tell us a little bit about how this ETF is a little different than the other ones out there in the gold space.
Yeah, we get a lot of focus on our particular product. We are competitively priced, but again, big differentiator is that, there's a lot of concerns around for ETFs. Is the gold really there? Is it physically backed? Our products are certainly 100% backed in physical allocated form of gold in bullion form, and certainly we differentiate of our product is we choose to physically store and vault our gold within Zurich, Switzerland, as opposed to some other competitors. And just given the historical track record, the fiscal, monetary, and geopolitical stability of Switzerland historically, I think that helps some investors who are looking to diversify their exposure of where their gold holdings are geographically located to help reduce any potential concentrations of where they decide to vault their gold. We have seen some interest from that perspective of our investors and our clients. But overall, our product is a great way to get pure price participation of spot gold price because our fund is 100% backed by physical gold in allocated form. So there's no concerns about leasing the gold or rehypothecation. Our gold is physically there, and it is tracks the spot price one for one as we do increase or decrease holdings based on flows for the fund.
Okay. And I also want to talk briefly about some of the other precious metals out there: silver, platinum, palladium. Do you feel like any of these are especially well positioned for 2017? I might guess that some of the more industrially focused ones are better given what you've said about infrastructure spending and other stimulative measures, but what's your take on this?
Yeah, that's a great point, and I certainly would agree. We do see a recovery in the overall global industrial production cycle, which should be a continued boon for silver, platinum, palladium, which do see higher annual demand driven by industrial applications. For silver, such as increased usage for solar panels and photovoltaic cells, has been a growth segment of silver demand, as well as it's a great conductor and great catalyst for other industrial applications. Platinum and palladium, much more so, are tied to the auto industry. They're primarily used for auto catalysts, which help reduce emissions for diesel and gasoline engines. And overall, we see continued increased demand for all three of these: silver, platinum, and palladium. While at the same time, we do expect reduced supply, which even more so for platinum and palladium, which continue to see multi-year supply deficits, and we do expect this to persist. Overall, this should be a boon for the overall direction going into 2017. But silver, is much more bucketed with gold in terms of conversations, and it does have a 0.8 correlation historically to gold, so it does track gold prices, but to a higher extent historically. And what's a little bit more unique about silver is it's driven much more so by its fundamentals, and we have been seeing a reduction of supply due to cutbacks of miners and reduced capital expenditures, which has continued to weigh on the mine production, as well as increasing demand for silver. And overall, when you put this together, we do see even more so attractive or constructive view for silver and platinum and palladium, as we do see continued expansion globally, economic recovery and growth, which should be a further tailwind. And additionally, as we do see increased GDP per capita, improve, particularly in emerging markets, we should see increased disposable income, increased consumer spending, which should be a boon for all three, and even gold in particular, as we do see an increase of jewelry demand, which on an annual basis is a significant portion for all precious metals.
I wanted to focus a little bit more on your palladium and platinum funds because, as far as I can tell, they're the only physically backed ones out there. We got, at least in the U.S., PALL for palladium and PPLT for platinum. Maybe you could tell investors how the physically backed approach is going to be slightly different than some of the futures approaches that are out there for investors in these markets.
Certainly, that's an important distinction for a lot of investors. And, platinum and palladium, we are one of the few options out there, and certainly in the U.S. on the physically backed side, the premier ETFs out there. And palladium has actually been performing quite nicely in the past couple weeks. So far, year to date, as of today, it's up about 26% and the top performing precious metal. But what's important for investors that are interested in investing in, in particular precious metals, which is unique because physically backed ETFs allow them to gain, to track the spot price very closely, and there's no concerns about contango or roll issues such as futures contracts, where essentially when your futures contract is looking to is about to expire, you have to roll into a new contract, which depending on the price movement could be disadvantageous, where you're essentially paying more or less based on where the new futures contract starts. And that issue is essentially a non-issue for investors in physically backed ETFs because, again, you're tracking pretty much the spot price of these metals, in particular platinum and palladium, which are much smaller markets in terms of size globally compared to gold and, let's say, silver. So I think it's a great way to access an investment in this space that pretty much tracks one for one the price less the fees expense ratio.
And sort of as the last question here, you guys also have a broad precious metal ETF, symbol GLTR, holds all four of the precious metals: gold, silver, platinum, palladium. I did want to ask you about the breakdown in this fund. We got about 56%, give or take, in gold, 29% in silver, and then 8% platinum, 7% palladium. Maybe you can give us some insights into why you chose that breakdown for this ETF. Is there a particular reason that it's overweight gold and silver like that?
Right. So the fund is based off a fixed weighting on an ounce, troy ounce basis, and initially it was set up based off of mine production when we launched the fund, and it's been pretty consistent in that range because again, these metals do move independent of each other, but over the long run they have a pretty consistent correlation. And the breakdown, as you mentioned, is about 60% gold, 30% silver, and then 10% platinum, palladium combined. And we do see the benefit of the anchor being gold. Gold's a great diversifier, but overall we see benefits of investing in a diversified basket of precious metals. First and foremost, we view precious metals as a core risk management tool compared to other quote unquote diversifying assets. They do maintain a low correlation to equity markets and other risk assets over long periods of time, and continue to do so even in the post-financial crisis world, where a lot of liquid alternatives or a lot of diversifying assets beyond traditional stocks and bonds have sort of lost that edge. And overall, we see the benefit from a diversification standpoint, as well as helping to achieve increased portfolio efficiency. So when you do include a diversified basket of precious metals into a traditional stock bond mix, historically we have seen an increase of portfolio returns while reducing portfolio volatility. So again, they are a great diversifier, which helps increase the portfolio efficiency or Sharpe ratio, which we do see a benefit for investors looking to help manage their strategic allocations over the long run. And we do see the benefit from a tail risk hedge perspective, which precious metals do have a great ability to help hedge against that potential risk of those large drawdowns.
Okay, great. Well, Max, thanks for joining us. I think this was very informative, and it should give investors a pretty good primer here for precious metal investing heading into 2017.
Great. Thanks for having me.
All right, everyone. That was Maxwell Gold, Director of Investment Strategy for ETF Securities. The ETFs that he discussed trade under the symbols of SGOL for the gold fund, SIVR for silver, PALL for palladium, and PPLT for platinum. And then we also have GLTR for the basket product. Some great tickers there. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.